Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the Deal Quest podcast. Let's get started. Ken Ritter is a former management consultant, corporate executive, and startup owner. After successfully exiting his first company, Kent turned his focus to real estate. Now Kent is the CEO of Hudson Investing, a multifamily investment firm which helps busy professionals scale and diversify their real estate portfolio with cash-flowing, wealth-building assets. Kent, welcome to the Deal Quest podcast.
Thanks for having me, Corey. I'm excited to be here.
Yeah, listen, I'm excited to talk to you as well. And, obviously there's some interesting things going on in the real estate market, and we want to talk about those deals. I know you had an exit as well. But before we get into all of that good stuff and what you're doing now, I want to take you back to when you were a little kid growing up, maybe 8, 10, 12 years old. What did you want to be? Because, I don't know, Mike, I'm guessing it's not a real estate investor, but you tell me. Maybe I'm wrong.
Man, if I was 8, I probably wanted to be like an archaeologist, astronaut, doctor, that owned my own business. I probably wanted to be all that.
And that owned your own business, huh? Oh, that's interesting.
Yeah. That was the interesting thing was I always wanted to own my own business ever since I was a little kid. And I don't necessarily know why, because didn't really have any entrepreneurs in my family. Yeah. I don't really know where I got that itch from. And it was kind of before there was this term entrepreneur, but I knew I always wanted to have my own thing. I just always thought that was like the pinnacle of accomplishment, I guess.
It's funny you say that, because I was the same way and had no models in my immediate family, for that. Everybody worked for, somebody. So yeah. I had one uncle, I think, looking back, who had his own business, and I thought that was pretty cool. Like
the best thing I had one of my buddies, his uncle owned dry cleaners and maybe like a car wash and things. Right, and I was like, yeah. And those are, now I know those are great cash flowing businesses. And I was like, this guy can just do whatever he wants. So, whenever he wants, and he's taking us fishing and all this stuff. So maybe that was it.
Maybe. All right. And one other question looking back, what was the first deal of any type that you can remember doing? It could be something small when you were a kid or early in your career, whatever comes to mind, like a first deal.
I can remember. I remember selling a bike when I was like 13, and I remember like negotiating with my friends and like just being like a hard ass about it, like. And I remember my friend getting mad at me and like walking away from the table, and we had to like come back together after that. I think we got a deal done, and we stayed friends, so it worked out. But I remember like it was a little tense there.
I love it. Those early experiences. Okay, so we're going to jump into and spend a lot of our time on the real estate side, because that's what you focus in now. But I know, you had the management consulting business. You did sell it. And, so why don't we just, was there any like one big lesson that you got out of that experience that maybe you still, you apply in what you do now?
The thing that really sticks out to me is if you're trying to maximize your value, you got to go to market. And what I mean by that, so here's why, because the reason that we sold our business is because we got a couple of unsolicited offers, and you get like one unsolicited offer and you're kind of like, oh yeah, whatever. You get another one, it kind of makes you think like, well, maybe we should explore this. Right. So we could have taken either of those offers. Right. And probably never known any better and been fine, but we knew enough we actually went out, we hired an investment bank. We went through the whole marketing process. We actually ended up at the end of the day with 11 LOIs.
Wow.
And so we had our pick of the litter. And so we were able to negotiate from a very strong position, and we were able to really maximize the value, and we were able to get a better multiple for that type of business than typically people get. And so the lesson is, if you want to maximize your value, go to market. I take that to real estate because like I love buying properties direct to seller because there's no broker in between. There's a lot less negotiation. But I would never sell on that side, directly to somebody. I always take it to market because of that exact same reason. If it's out to the market, you can create this competitive environment. You're going to maximize your value. And I mean, at the end of the day, it's what we're trying to do for our investors. So I think that's a good lesson.
Yeah, it's interesting, this tension, right? Because especially in real estate, one of the things I like about real estate, and I've dabbled in, I've done some investments. In fact, I've done more than dabbled. It's not my main business, but, I've had a couple of funds, over the years where we put in our own money, raised some capital from others, and did some, everything from a couple of small condo conversions to some multis. But I don't do it regularly, and I don't have anything active right now. But the thing I always like about real estate is that it's an inefficient market, especially on the residential side, right? And
yes.
for audiences that, for people in the audience that don't know what I mean by that, it's that like I have a lot of insight into the stock market. I know, a lot of people who are on various aspects of it, from the old guys on the floor of the New York Stock Exchange to, all people who wrote the program Trading Systems for First Boston or whatever. I mean, it's amazing how highly technological, efficient, big players, right, are in there. High-end commercial real estate has come that way, right? Cap rates are pretty tight. But, when you get into other aspects of the real estate market, so I have a personal belief that I can't compete as an individual in the stock market, right? So I invest money in a diversified portfolio and leave it in there for the long term and blah, 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 because there are other people who have high technology, inside information, contacts, whatever, that I can't compete with.
Right.
But real estate, and certainly on the residential side, is really much less efficient. It's not like that. I always find that it's, you can compete better.
And you can find value. Like you really can find value. Well, I mean, I can tell you an example of a deal that we're working on right now. It was a marketed deal, meaning a broker had it listed. Yeah. But I'll just be honest with you, the broker wasn't very good, and the broker's network isn't very big. I mean, really, that's what it's all about. Is it's about the broker's network, because that's where you can find deals, because there's just deals that people don't know about, right? Because a lot of these deals aren't on a national platform, somewhere like the stock market where everyone's trading all over and everybody knows about all the deals. And so I think we were able to get a great deal on the property just because of bad marketing and because not a lot of people knew about it.
Yeah, and that's sort of where I was going with it. When you said this tension between wanting to buy off market but sell on market, right? That's right. Yes. It's because of that, right? I mean, you want to, and it's interesting. Everybody's always looking for those. I know all the buyers I know is looking for. We were looking for off market deals, right? Because the on market deals have more competition, and then there's greater efficiencies in them. So that's kind of key to our strategy, really, and that's why we stay.
So we intentionally stay under 200 units, because when you go above 200 units from multifamily standpoint, that's when you attract the bigger players. You attract the bigger players, REITs, PE firms. Yep. They only go 200 units plus. So we work in this pocket of like 50 to 200 units where it's too big for like a mom and pop or even like a group of buddies to come together and really do successfully. We buy from a lot of those groups, and then too little for the big guys to pay attention to. And so in that, we're able to, it's an even more inefficient market in that space. And so we're a sophisticated player in that market. And because of that, I think we're able to find a lot of really good deals and with a lot of meat on the bone still. So like we're strategically trying to avoid that competition.
Yeah. No, and that really makes sense. So let's talk about, you use the phrase a lot of meat on the bone, right? So like what causes there to be meat on the bone, right? Is it because, the easy answer is, all right, maybe somebody's underpricing their building because they don't know the market as well and they haven't put it on the market, whatever. Okay, so we have that. But there's other stuff that creates meat on the bone, right? Where you see opportunities maybe that the existing owner or maybe other buyers don't see?
Yeah, 100%. And one of the probably my favorite thing about commercial real estate, there's a lot of them. Probably my favorite is this idea of forced appreciation. Meaning that if I can come in and I can increase the net operating income, then I can increase the value of the property. By a multiple of right now in the market, 20 to 25x. For every dollar I increase the income, I'm increasing the value by $20 to $25. And so that's what I mean by meat on the bone is if I can come in and I can solve problems, whether it's my favorite are management inefficiencies, because I know we just get the old management out, put our management in, and boom, we solve the problem. But also just a lot of times these properties are undercapitalized, meaning the current owner, especially if it's like a mom and pop style, they don't have a war chest to pull from to keep the property fixed up and do all the deferred maintenance and even make improvements, right? They're just pulling money from operations. And so we come in, we're able to infuse the property with capital. We're able to renovate units. We're able to take care of deferred maintenance, de-risk the property by, putting new roofs on or fixing plumbing, all these things. And in doing that, we're able to increase the rents and decrease expenses in many cases, all that to increase the NOI, which is going to drive up valuation. So we can so we're not just relying on the market. Like when you buy a single family house, it's a market-based valuation. So it's only worth as much as what the other houses around it have sold for, right? Yeah. With commercial real estate, it's an income-based valuation. So if we increase that income, we increase how much it's worth. And that's really the beauty of being able to control your own destiny with commercial real estate. Yeah.
In that way, it's similar to buying and selling businesses in that the more efficiently they run, not only do you make more cash flow, at the time, but when you exit that business or sell that property, you're going to get, a multiple on that cash flow or EBITDA or whatever, or net cash flow, whatever, depending on what you're selling, how it's defined. But it basically comes down to, revenue minus expenses. And
100%.
And there's a multiple on that, right? Which is
100%.
So for every dollar you increase cash flow, like you said, right now, you're getting $25, call it.
Yeah. So it's beautiful because like little stuff adds up, where like we will, for example, we have a program on all of our properties where we actually install fiber optic internet on all the properties. And so we inevitably become the internet service provider. And it's like a wholesale retail model where we're paying, a certain price for it. And then we're charging the residents at a market rate. And it creates a spread of typically anywhere from $35 to $50 per unit a month. And when you think about it, you're like, oh, okay, maybe that's not that much. It doesn't sound like a lot, right? But you think about it over 100 or 150 units in over 12 months, and then you multiply whatever that number is by 20 or 25, and it becomes meaningful dollars.
Yeah.
And you do that with like 4 or 5 different things, and all of a sudden, like you're talking real money.
Yeah, talking real money, exactly. So. Question on that then, in terms of your approach on the multis, because there are some investors who are buy and hold. There are some who are buy, improve, bring up the rent roll or whatever, and then sell. Some do a combination. What's your focus?
Yeah, we kind of sit in the middle where we are. Our typical hold time is somewhere between somewhere right around 3 years is probably our average. I mean, we're targeting a 3 to 5 year exit typically when we're underwriting deals. And just because of market conditions, we've had some properties that have exited in 2 years just because we knew we could hit our 5-year numbers in 2 years, and we said, okay, let's chalk up a win. But yeah, so we're essentially buy, fix up, hold for a little bit, and then sell.
Right. Because you're going to fix it up. You want again, then get the rent roll for X amount of time. People see
that's right. Yeah. You're going to,
at those new numbers, and then
exactly right, because we're gonna either sell or refinance based on kind of the last 3 months of operations. So we get that going, and then we're able to seriously increase the value.
So let's take it back for a second and talk about how you got here, because in our pre-call, you've had a journey that is somewhat common for successful folks in this industry, right? Where you started right on the individual home buying flip, right? Flip market, and then have evolved into doing bigger deals, multi deals, and then even some ground up. I know you mentioned. So let's talk about that journey a little bit. Like why, it's, in terms of getting your feet wet, what you learned from those small deals, why you move away from them. And I'm assuming you're probably not doing single family homes anymore. Talk about the journey.
Yes. No, yeah, I'd be happy to, because I think there are some good insights here. If there's people that want to follow this journey, I can help maybe short circuit some of these things because I had to learn it. So I started out, the first thing that I started out doing was actually building out a note portfolio. So I was selling houses on contract and I was holding the debt. And I was only doing that because a family friend, that was his strategy. And that was kind of my way into real estate. Right. And then the big eye-opening moment was about a year after I created one of those contracts, about a year after one of the folks sold the house, and they bought the house for $70,000. They sold it for $140,000. And I got the HUD statement, the closing statement, because I'm the debt, right? And I'm looking at it, I'm like, man, this guy just doubled his money in a year. I mean, hardly did anything, right? And I'm getting my loan paid back. Well, like all well and good, but like this guy doubled his money. I was like, okay, so I got to get out of the debt game. I need to start buying assets. So then we got into, because I had a friend he had done fix and flips for about 12 years prior to when we started doing it together. So I'm like, okay, you know what you're doing. I've got capital. Let's get in, let's scale this business, right? Well, I won't get into it all, but a ton of lessons learned of why it's really tough to scale a fix and flip business, and manage. Because when you go from your own crew to having to manage, 4 or 5 crews, that's a totally different environment. And so really the fix and flips, I mean, I was also looking for something that was passive, right? For the most part. And a fix and flip, I mean, that's a full-time day job. Yep. And it's ordinary income. It's not capital gains. And so the tax treatment isn't as good. And
Yep.
so while I learned a lot of good lessons, it wasn't scalable, tax treatment, all those things. I realized this is not what I want to be in. So at the same time, we were building up a small rental portfolio too, of like singles and duplexes, because we were essentially either holding them or we were flipping them as we fixed them up.
Yep.
And and that gets a little better, right? That gets you into capital gains. That gets you more passive income. But the problem with a single family house is if your tenant's gone, you're on the hook for that mortgage. Like there's nobody else.
Right. Yeah. It's binary. It's ones and zeros. It's
exactly like
yes or no.
in most of our multifamily properties. I mean, because we do this analysis, we could drop the residency or the occupancy to 70-75% and still be able to make our mortgage payment, right? Like that's our break even. So it's a lot different. And then you start doing the math on how many houses you actually have to acquire to get to the cash flow you want to get to. And like, that's a hell of a lot of houses. And once you realize how hard it is to buy a house, you start to realize. And so anyway, so we got out of that. So I was really looking, and I think this is part of my consulting mindset. I was always looking for something that's scalable, that I could build a model and grow. And none of those things fit that. And so that's when I really learned about multifamily. It's like, okay, well, instead of buying 100 houses, I can buy 100 units under one roof and do one transaction. Wow, that seems scalable. And still though, I had in my mind, like, at this point, I'm not bringing in any other investors. This is all my own money or like my partner's money.
Yep.
And then I had a mentor step in at the right time. I met a person and they're like, okay, well, cool. You go buy a 50 unit. You got all your eggs in one basket in this 50 unit. You're still a landlord. They're like, I don't think that's what you want. And they opened my eyes to what like a syndication model and the ability to bring other people into the deal. In that way, diversify my own funds, also use other people's funds and be able to create a portfolio instead of having all your money in one property. And from there, like the light bulb really went off for me of like, this is what I want to do. And
so have you been syndicating? Have you been doing deal by deal raising capital, or have you put together a fund, where you're doing multiple properties? No,
we haven't done a fund. We've done portfolios, but it's always been identified properties. Yeah. So we've never done a semi-blind or like a blind fund. It's something that it's something on the horizon. I think. I think it's like a natural evolution, but I also like the individual properties. And I think a lot of our investors do because they can touch and feel and see exactly what they're getting, so there's pros and cons.
Yeah, I mean, it's interesting. There are definitely pros and cons. I mean, we were, and again, we did a couple of funds a long time ago, and so I'm not. But what motivated me, and we did our funds that were just a blind fund, and it's hard to raise money that way because they're just trusting you, right? They can't evaluate a deal. But on the flip side, what it solved for, and this is the one thing it does solve for, is that
there were a couple of deals that were the kind of deals where you needed to move today, like where that opportunity was there. And even spending a couple of weeks, putting capital together, could cost you the deal. And once I lost out on two of those that I knew were going to be home runs, right? Just because they were big enough where I didn't have, my own capital to fund them all. And, and one I came close, scrambling to, get the money and someone else swooped in there. That was my frustration that had me, that had me.
I know exactly what you're talking about. And part of my story that we didn't hit on a ton in my journey was, I went to really work at one of my mentors' private equity firms for about 15 months and kind of learn the game from the inside. They have about 20,000 units. And that was the model that they worked in, right? And they had that war chest there so they could just execute quickly and they could just beat everybody to closing. And that's a huge deal. And so I definitely understand the value in being able to just, because that's really at the end of the day, what matters to the broker who really is going to drive or steer a lot of those decisions is your speed to close and the surety of execution.
Yeah. Yeah. But listen, I mean, there's, you've been very successful. Plenty of people do, deal the deal. And there are a big advantage to that because, you have a broader pool of investors because you're not asking them to just stay, it's sort of like, a lot of them have run into trouble more recently now. These SPACs, in the public company market where they say, hey, we're basically going to take over a public company. You're going to invest in it and then we'll decide what we're going to do with your money. Right. As opposed to investing in an operating company.
And I think that I think there's just so much dry powder and there's just so much money searching for yield that kind of stuff 100%. Works in that environment. Right. I think as interest rates are starting to squeeze people, I think I think we'll probably see less of that.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
So let's talk about that. Let's transition to what we're seeing because, obviously, in the real estate market, in the corporate market, everywhere, there's just been, the abundance of capital, and money, like you said, powder to burn, has been crazy over the last number of years. Valuations on the corporate and the real estate side have gone, I've been saying for several years now that we're in a time when no good deal will not get funded. Right.
Yeah.
There are still deals that are not fundable because they're not good deals.
They're not good deals.
No good deal will get,
Right.
But we have some signs and listen, I'm not asking you, none of us have a crystal ball. Who knows what's going to happen, but what are you seeing so far? Obviously we got interest rates starting to push up and the Fed has indicated they're going to continue to go up. We have some, the stock market's been bumpy lately and, and overall concerns about, are we going into a recession, blah, blah, blah. All right. I guess the first question is, have you seen any specific impacts yet in your market? And why don't we use this as an opportunity to talk about what your market is? And then, to the extent you have any views on, what might happen going forward, I'd love to hear.
I think there's so much to unpack here, and I'm an econ guy. I love talking about this stuff and trying to follow it and really understand what's going on. So, I think a couple things that I think are valuable to point out, and I guess we'll kind of bring it all back together to my market. But I think one thing that's really valuable to point out is, interest rates are what everybody's kind of grabbing onto right now. That's what's hitting the headlines. That's like the FUD. That's the fear, uncertainty, doubt that the mainstream media pumps because that's what people are going to listen to. Right. But, and that's what I'm having tons of investor calls about. Hey, interest rates are going up. What's going to happen? The thing is there's so many other levers in commercial real estate besides interest rates that create or destroy value, right? Interest rates is just one of them. So my take on interest rates is that like, yes, they're going to go up. We've been in an unprecedented environment for the last 10 years of zero borrowing rates, right?
Totally artificially low. I mean, it's,
right.
People don't
right.
realize the anomaly was not that they're going up. The anomaly was that they were so low for so long.
100%. And at a certain point, you got to get off the merry-go-round, right? And so interest rates are going to go up. And if you look at like forward curves for SOFR, which is a rate that a lot of our variable loans are benchmarked to, it looks like the prediction, at least in forward curves, are always wrong, but it's the best info we have, that they're going to peak kind of next summer and then come down and kind of normalize, right? And so what we've done is we've just really, in our underwriting, we underwrite to that forward curve. So as long as rates do what we think they're going to do, we're fine with that. Like, because we like the deal at that, right? And then what we do on top of that is we put a rate cap kind of just above where that curve peaks, so that if we've got an insurance policy to protect against the downside, right? So if rates go up higher than we're predicting, we're protected. And so that's kind of how we're hedging our risk there. But I think the deal has to be good. Like, I don't think you should be buying like in the money caps, because you have to keep your interest rate at a certain level. If the deal doesn't work, if the interest rate moves up a couple points, I mean, it's still like a 6% interest rate. It's not a crazy rate, right? I know that doesn't work if you're buying like a 3% cap rate deal, which like people have been, but like in the Midwest where we are, I mean, we're still relatively conservative in that way. So the reason I say all that is the way we haven't had much of an impact. We are, I guess, more conscious about our rate caps and making sure that we're capping in the appropriate place and things, but we've always underwritten to those curves. And so we've always kind of operated in that way. Here's something I want to point out though, because it was pointed out to me, and I think it's super interesting, because I think it's a really common misconception to say that just because interest rates go up, that cap rates have to follow. They're not correlated. And there's an economist that I really like. His name is Peter Lindman, and he's a professor at Wharton, I believe, but he follows the commercial real estate market. I subscribe to his newsletter, and he actually took it a level deeper, and he said, it's not actually that cap rates correlated with interest rates. What they're correlated with is the amount of money that's chasing deals. And when interest rates are lower, money's cheaper and there's more money. The thing that's interesting about right now is that whether interest rates go to 6% or not, there's still so much money out there that's trying to chase real estate that I think that's going to, from a valuation standpoint, I think that's just going to kind of bull over wherever the interest rates go. And I don't really see cap rates moving with interest rates in a meaningful way. So, because I mean, people tell me all the time, well, interest rates go up, cap rates have to move up. And I think a lot of investors have that in their mind. And so, they're looking at, well, it's this, but you're going to have to sell it like a 6.5 cap because interest rates are going to be at 6. I'm like, there's no way the market moves in that way. And so, sorry if I got too technical. I don't know, but that's.
I love it. And actually, what I'd like you to do, because we have some listeners definitely who understand this stuff, who are real estate investors, understand. But we also have some folks that maybe are more focused on the corporate side. Maybe they'll
of course.
So just let's explain a fundamental term. What is a cap rate?
Yeah. Good.
Just for some of our listeners, in case they don't understand what that is.
There's a couple ways to look at it. One, it's your yield on your investment. It's your unleveraged yield on your investment, right? So if you had no debt on the property, and you had $1 million invested and you made 100,000, it would be 10%, right? The other way to look at cap rate is it's like the inverse of the multiple. So if you're used to like a price to earnings ratio, I don't know what's the right way to explain that. I kind of look at it as the inverse of that. So if a cap rate, for example, is 5%, that means the multiple on each dollar is 20x.
It's 20, right?
So like for every dollar I increase income, I'm increasing value 20 times. If the cap rate's 4, it's 25. Right. So if that makes sense. So it's really it's mostly used as a valuation metric.
Right. And you can back into an assumed rate of return, which is really what it's showing. Yeah. So for the people who think from a corporate point of view, it's really, what's the expected I mean, you explained it better, but a simple way to say it is maybe is, what's the expected return on your, on your capital, right? So,
yeah, it is. And the beautiful thing about real estate is you can lever it, and then your return gets a lot better, right?
Exactly. So, right. And the cap rate's the unlevered, right? So obviously, as when you talk about like people buying at a 3, what that means is that they're really, really tight, right? Like it may
there's
work
not much cash flow, right?
That's
what
it means.
Cash
flow available, right? There's not a lot of leeway there. So for folks buying deals like that, interest rates going up could be
because your margins are really thin, right? And so because your biggest expense that's going to come after your NOI is that debt payment, right? And so and that's really the only way to. There's other ways, but like the first way to screw up a real estate deal is default on your loan. If you can pay your loan payment, you can usually live to fight another day, right? You can cut operating expenses. I mean, like I told you, on most of our properties, it's about a break even of like 70% occupancy. So you could lose 30% of your occupancy. You could drop your rents. I mean, you could do a lot of things to stay alive. And as long as you can make that loan payment, what do we know every time we come out of a recession? Well, there's kind of a culling of the herd and prices improve. And so as long as you can make that loan payment, but the lower the cap rate, the tighter it's going to be.
Yeah, totally. And, the other thing, going back to the conversation, I'm glad you pointed out that, some of the people get over fixated on one, like interest rates, right?
Yeah.
And they make assumptions based upon that. Yeah. Of course, then the media plays into the fear and all that stuff, which drives me crazy. But
can I give you one metric that we're looking at? So interest rates. So we have a couple properties that we've had under contract since in the March timeframe, and interest rates have moved a ton since then. But rents have moved 3 or 4 times higher than interest rates. And so when you look at how those properties have been affected over time, I mean, we're beating in a lot of cases like our year 2 projections when you look at income, because rents have grown. I mean, we were underwriting 4% rent growth perhaps. And I mean, we have one deal where rents have grown 20% on that property in that same time. And so it's just, I mean, that's why there's a lot of levers that can be pulled, right? And the thing about commercial real estate, and the thing about rents is traditionally, and we're seeing it right now, is they move up with inflation. And we're absolutely seeing that right now.
Yeah, and that I'm glad you went in that direction, because that was the direction I was thinking about as well, and especially, and again, I'm not, nobody can predict the future. We see how all these things play out, but right now, I mean, I read a statistic from last year into this year in big cities that rents were averaging 14% increases, right? Mm-hmm. And when you take into account that there are a number of big cities like New York, San Francisco, others have rent, stabilization restrictions on how much things can go up, which depress that, average. It means the free market properties are going up way more than 14%, right? So you have that, you have low unemployment, you have rising wages, so people can actually afford, higher rents and the inflation, arguably. And again, I don't want the listeners to think, I understand that there are people who, with gas prices and everything else going up, who are struggling. So I don't want to minimize, that. But what I'm saying is there's a lot of other factors, and you got to look at, employment being high, employment going up. And listen, also, frankly, it depends on what kind of properties you're in and what level, your tenants are, right?
That's right. 100%.
Are you A buildings, B buildings, C buildings? Are you, dealing with, if you're dealing with a lot of folks who, who got hurt by the pandemic because they're in low-end jobs, or on their government programs, okay, maybe, it's a different market than dealing with a middle-class building or a higher-end building.
Yeah. I mean, but we're seeing exactly like you said. I mean, just, I give you an example. There's in Indianapolis where I am. I mean, there's a massive industrial complex in the area. It's about 30,000 warehouse jobs.
Yep.
And the wage in the last 6 months has gone from $18 an hour to $23 an hour there. Huge. I mean, and you see significant increases. And so I think that's a good thing. I mean, we're actually seeing the wage inflation happening, not just kind of the asset price inflation, things like that. So with this much money out there, I don't know how we don't have inflation. I mean, I think it's, I mean, and so I think that it's something that when you're in an inflationary environment, I think you just want to be invested in things that rise typically with inflation. I think what I'm telling everybody right now is like, look, invest with me, don't invest with me. Just please don't have your money sitting in a bank account right now while inflation is running at 8%, because you're just losing out.
Right. Because it's just worth less and less. So let's talk about that a little bit, because you say invest with me. One of the things that's, it said in your bio is you help busy professionals scale and diversify their real estate portfolio with cash flow wealth building assets. So let's clarify so the audience understands, what you do there. Is it just, is that focused on the investment opportunities that you provide for people in the deals you do, or is there any training you do? Like, let's talk about what that means.
Yeah. Great question. So I don't have any like formal training or coaching programs, but I put out a lot of educational content kind of between my podcast and videos, and got a website, kentritter.com, with things on there for new investors. But primarily, it's about the deals that we're bringing to market. We're trying to bring, so I'm in the Midwest, we focus in the Midwest. So we're really focused on bringing solid cash flowing deals. It's like workforce housing, B and C class multifamily, kind of just bread and butter stuff that we know no matter where we go up or down, like we're still going to cash flow. We're still gonna put money in your pocket quarterly, and that's really our primary focus. And then we know if we do it right and we hold it for a good period of time, that appreciation will come too. But we're really cash flow focused.
Yeah, love it. And listen, we have a decent segment of our audience who are entrepreneurs and business owners, and maybe more so for the corporate deal stuff that we do. But I always encourage those folks. One of the challenges of being an entrepreneur is that many of us have most of our net worth and assets tied up in the value of in our business. Mm-hmm. And in the early days, I think that's important to do. I mean, I don't believe, there's this talk about, multiple streams of income, whatever. I remember somebody said, I'm trying to remember who it was, but I took some course or something, and I love the way they said it. They said, if you study most people, right? Yeah, at some point they get to multiple streams of income. But usually the way they have become successful is that they had one stream of income or one main area, right? Yep. They say, don't put your eggs in one basket. Realistically, what happens with most successful people is that they have their eggs in one basket. They treat that basket really, really well.
Right.
And then at some point, when they get to a certain level, they start to diversify, out to de-risk, that investment, takes itself off the table. And that's one of the things I really encourage my corporate folks and entrepreneurs to look at. And real estate's a great way to do that, to diversify their risk and find other ways to put their money to work.
And my goal is to just make it totally turnkey for folks. So you get real estate exposure, you get all the tax advantages of being a direct owner, which means we're giving all the depreciation back to you, right? And you get to offset your gains, but you don't have to do any of the work. And that's kind of like, whenever I meet with another entrepreneur, I feel like we have kind of the same conversation where they're like, because they're usually looking at like actively getting into real estate, being like, I'm going to go out and buy something here. And I'm kind of where you're at. I'm like, look, if you already have a successful business and you already are creating a ton of value, like your highest and best use is going to be focusing on growing that business, not on trying to do something else in real estate too, because you can go a mile in one direction or like an inch in 20, right? And so like that's where I think like we provide value, because it's like we let you do that, focus on what you're good at, let us focus on real estate. That's what we're good at. We get you that exposure, that diversification. Everybody maximizes what they're doing. Everybody's in their highest and best use, right?
Yeah, and that's folks. Ken and I have not had a conversation where I've used that phrase with him, but listeners know that highest and best use conversation is something I've repeatedly talked about on this podcast and in my life, because it's a fundamental, not only thing that I talk about, but it's a fundamental principle in my life, is that I try to only do, work every day to only work in my highest and best use areas. It's never 100% that way, but I keep striving, to get it from 80 to 85 to 90 to whatever. And then, surround myself with people who are great at what they do. That's, are outside my highest and best use areas. So you are preaching to the choir with me, and certainly with with some of our listeners. They've definitely heard this before.
Awesome.
So before I ask you my last two questions, because we're coming to the end of time, and I know we could talk forever about this stuff. Is there any last thing you want to say in terms of whether it's any big lessons or more, what's happening in the market, or thoughts? Anything that'll be valuable to our listeners.
Yeah, I mean, I think we hit on a lot of good things. I guess my my takeaway, I think I already said it, is like, this is a great time to invest in tangible, real assets. I'm sure there will also be buying opportunities from dips in markets and things, but like, so invest in something. Don't let your money sit in the bank account. That's my big thing. I mean, I know so many people that have their money in bank accounts because they just don't know what to do with it. And it's okay. It's been okay the past 10 years. It's still a 0.05 interest rate, but
right.
It's not okay now because, I mean, if you think about, you're losing 8.5% a year on that money. And so there's a lot of good investment opportunities out there. Just find take ownership to deploy your capital and take ownership of your investments.
Love it. I definitely believe in that. All right. So before I ask you my final question, I know you gave it quickly before, but website or any other contact information so people can find out more about what you do and maybe learn a little bit from your content or look at some of the deals you might have available for investment.
Yeah. So if you go to kentritter.com, you can see everything. So we do a weekly blog. We have, the podcast is there. You can also find the podcast. It's called Ritter on Real Estate. It's everywhere you listen to podcasts. It's up there with Corey's, hopefully it's up there with Corey's. And, and then we also have, if you're new to real estate investing, like one of the biggest barriers could just be like the jargon and terminology and kind of how these work. And so we've got fact sheets and terms and things on the website to help new investors just kind of, so when you're looking at deals, you understand what's going on and how the calculations work and things. So yeah, that's definitely the home base.
Awesome. So my final question on the podcast, Kent, is always about my highest value, my highest ideal in life, which is freedom. And for me, that means everything from freedom from all people around the world from oppression to why I'm an entrepreneur and I haven't had a boss in decades. So what does freedom mean to you and how does it impact your life and business?
Yeah, I mean, freedom was really what drove me down this path for real estate. I mean, it was, so we sold the consulting business and that was great, but I became an employee of the company we sold to. I had my earnout that I had to go through that process. And the thing about consulting is you travel constantly, right? And so it was fine when I was single and I was just like jet setting. But when I got a wife and a couple kids and now I have 3 small children, I wanted to be there for them. I wanted to be around. I wanted to be there for the events. And so that's why I was really looking for something where I could create passive income and be home. And now, I mean, I'm not passive. I'm very active in this, but I still have the freedom because I'm my own boss to say, hey, it's nice out. It's 2:00. Let's take the kids to the park. I'm not chained to a desk somewhere. And so that's what it means to me. It's like, be the husband and father that I really want to be.
Love it. Ken Ritter, thank you so much for being a great guest on the Deal Quest podcast.
Absolutely. Thank you for having me.
Thank you for joining me on this episode of Deal Quest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the Deal Quest community. Join the Deal Quest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corey.com/dealden. That's corey.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your Deal Quest will bring.